Right. Today, I want to talk about one important thing. That is the US stock market out of ICU? Okay. This past week was defined by turbulent trading, highlighted by a sharp spike in the Cboe Volatility Index, which reached a peak of 65.73 on Monday. During this time, the S&P briefly plummeted by more than 4%, right? So systematic funds, which make investment decisions based on predefined rules and use volatility as a key indicator, reacted quickly by shifting their equities to bonds and cash. Prior to this upheaval, some volatility managed funds had increased their equity holdings to an unprecedented 110%, only to slash it to about 50% amid the turmoil, the most significant reduction since the pandemic began. Now, not only that, we have also quantitative trend following funds also felt the pressure, forced to adjust their market positions due to their program strategies. Now, by Thursday, however, the S&P had rallied. Okay, we saw that big drop by Thursday, it rallied, marking its largest gain since 2022 with a 2.3% increase. By the week's end, it had risen over 4% from Monday's low. Okay, so the VIX then settled back towards 20, indicating a return to a relative market stability. So you can see the VIX, when the market was in turmoil, it shot up, and VIX here basically is a fear factor. It tells the ability for that market to move up or down by how many percentage points is based on the data given right over here. So when it comes back to 20, it's like saying that everything is back to normal, probably back to normal if it can go even deep below 20. Okay, so amidst this backdrop, some analysts have reconsidered their positions on the labor market, suggesting that non-farm payroll figures above 100,000 are still reasonable, and dismissing the uptick in unemployment as an anomaly possibly related to weather factors. This is just news by all these analysts and newscasters scrambling to explain what had happened, because probably it's the same group of people calling doom and gloom in the market, saying that this is going to be the worst crash ever, only to be proved wrong at the current times. And it's now with the market recovering, they said, oh, okay, not that bad, because we are sticking with the same number, 200,000 for payrolls, non-farm payrolls. That is a bullish number. Anything below than that, below 200,000, you would need some scrutiny. Okay, so with it now, they're saying that 100 is still okay. So this is not something that I'll say okay. Of course, I agree 100,000 is still a significant number right over here, but we need to check, because as you know, the non-farm data, the details in it is much such anyway, so we don't know how the actual representation of it. Now, so with all this scrambling to explain why the market is recovering, this behavior starkly contrasts with the more apocalyptic predictions circulating before. Now, factors such as unwinding of the yen carry trade, volatility-based flow triggers, or pre-programmed exits exacerbated the market's fluctuations, which were more pronounced due to the typical lower liquidity of the summer months. So if you want something to cool down, for the market to pick up, it has to be after summer, because summer months are the times where liquidity is low. A lot of traders, they would be on holiday, and when they're holiday, there's not much liquidity in the market, and when you don't have liquidity in the market, it doesn't take much to move the market. Okay, so that is the understanding that we should know. Okay, so why we have seen the market move so much and now recover back again in such a short time. So what's the real story here? Let's delve into some specifics about last week's market movements, okay? So at least you have a better understanding. Number one is that why it did not turn into that bloodbath that everybody's talking about in YouTube, the doom and gloom thing. Now, first of all, the market 9.7% drop falls within the norm for presidential election years, according to an analysis by Oxford Economics, which notes that market corrections of at least 10% typically occur every 18 to 24 months. And it's high time for one already. So we have just seen, in fact, it can actually drop a bit more because it's only 9.7% and not 10, right? Not only that, tech stocks were a victim of high expectations. Tech giants like Amazon, Apple, and Nvidia were among the hardest hit, primarily due to investors' expectation not aligning with otherwise solid earning reports. I mentioned that in the past. I said, although it's not stellar, as in falling in line with the expectations, they are still making money. Okay. So as long as stock is making money and is making much more money than the previous quarter and the previous year, I think it's still solid, right? So nevertheless, these major tech companies continue to report profits, right? So which remains a fundamental driver for stock prices. That's why you make money better than last quarter. Yeah, that stock is still good, you know. So let's look much deeper than that, not just concentrate on the magnificent seven. Okay, let's move and look into the S&P in general. Now, regarding Q2 2024 earnings, FactSet reported that with 91% of S&P 500 companies having reported, 78% surpassed earnings per share expectations, and 59% exceeded revenue forecasts. So this is strong data. It can support the economy. And not only that, the projected earnings growth rate of 10.8% for the quarter, if realized, would be the highest since Q4 2021. So if the market is really in dire straits, right, you wouldn't get, I don't think you can get this kind of nice numbers, right? And not only that, what about the future, the next quarter? What are we expecting? So for the upcoming third quarter, the guidance appeared mixed, with 47 companies issuing negative EPS guidance against 39 positive, a common scenario as companies set conservative expectations. Low balling guidance is not uncommon, and we will need to wait for Q4 to see the accuracy of this guidance. Okay, so only the next quarter, then probably not that good, but then we get a lot of lowballing. This is something common. Now, for those who don't know what lowballing is, it is the CEO or the CFO coming out saying that, next quarter, we won't be doing that well because we think of the reasons is so and so and so. But later on, we found out that when the real results come out, it's actually higher than what they predicted, because then that will show that they are doing much better than what they think they would have. And by lowballing, the economies would actually set a lower scale for the company earnings to pass, right? And this kind of things actually brings a lot of positive feel-good factor towards the company and more buying. So that's why sometimes you have companies, they like to lowball, their earnings. Okay, so this is one we've seen so far. Next quarter, we'll just have to wait. Now, there's also one particular issue that everybody talked about. It was the SAM rule, okay? Or they call it SAM rule. I don't know how to pronounce it. Basically, you had the creator of that rule coming out. So Economist Claudia Sahm, while acknowledging that her recession indicator has been triggered, suggests that current conditions might not necessarily lead to a recession. Okay. Uh, Key economic indicators like household income growth, consumer spending, and business investments remain strong, and GDP growth has exceeded expectations. So when you have the creator coming out and said, "Hey, this time my indicator might not be working," I think you better listen. There are reasons. So at the end of the day, my conclusion is simple: the initial panic episode was excessive. Okay, it's as simple as that. And it's mainly triggered also with all these pre-programmed algos moving in, cutting losses, pushing the market in areas that usually don't happen in the past. As we move towards the IT world, a lot of this trading actually move towards all this automated trading. So does this mean that the market is totally out of the ICU, right? So think put it this way: the recovery does not mean we're completely out of the woods. It's just that the condition does not warrant dire economic conditions, all right, as yet. So caution remains as the full economic landscape continues to unfold. So far, we have seen, yes, it is not, still okay for the time being. We don't see a recession until further data proves otherwise. Okay, so that's the sharing for today.